got some turbulence up ahead. Reach out to the pilot's planner. Welcome to the Wealthy Pilots Podcast with Scott Osborn. We're going to talk about end-of-year planning, some things to think about as this year is almost over, and getting into next year a little bit as well. So, Scott, let's get into it, my friend. How you doing this week?
Outstanding. Yourself?
Doing very well. Thank you very much. One holiday is down. The other holiday is almost upon us. We're about mid-December here, and thought it might be a good idea to throw out a couple items for people to think about end of year, kind of planning tidbits, whatnot. And end of year, you kind of think, well, it's, 2 weeks left in the year and it's kind of late. For some things, yes, but for other things, you still kind of have till the tax time, in March or April. So still could be some useful information in here. So let's dive into a few things. Where should we start?
Yeah, I think, there's two portions of it here. One is, what are some of the things we have to have done before December 31st? You do not want to wait until New Year's Eve to do any of this stuff. Obviously,
people are not going to work that whole last week. So you mean to do it like this week, really?
Yeah. I mean, we always tell folks like, hey, if Charles Schwab or Fidelity, they got an example of like, hey, by December 6th, you got to have that stuff in to give them time to process it all.
We're dropping this after that. So
exactly.
Yeah.
So realistically, if you're getting something in by the 15th, you got a pretty good chance of it getting in. But
so you're talking like Roth deadlines or conversions, things like that. Obviously, hopefully you've done that already.
Yeah.
But yeah. Okay.
Yeah. So if we just kind of run down the list, if we look at from a Roth standpoint or IRA contribution standpoint, contributions can be done after the first of the year. You got until the tax deadline to get those contributions in. No problem.
Pretty funny you mentioned that. I just went to go add some contributions and I noticed that it was like, do you want to add them for the 2024 calendar year or the 2025 calendar year? So it was asking me that, right now as well. So yeah, you can kind of pick and choose that a little bit.
Right. So, so you have that little window where like January through April 15th, you can do both years. You're able to do that. Now, from what needs done by the end of the year, any Roth conversions need to be done. And that means like if we're moving it from that pre-tax, tax deferred bucket over to that tax-free forever Roth bucket, you'll want to do that. We always recommend when you do those to not withhold any taxes and just pay the taxes from cash if you can, because it maximizes the amount that you can get over into the Roth. So that's got to be done before the end of the year. When you do that, they're going to issue you a 1099 to file with your tax documents. There's another couple forms that get issued from the custodian, Schwab or Fidelity. And then you'll want to make sure that those get to the CPA, right? But that's got to get done. A lot of folks, when they're looking at the Roth conversions, for some of our retired folks, you got to be a little bit more, if you're late stage career, getting close to that age 65, you want to be conscious of how much you're converting, because you can trigger some, higher levels of what we call the IRMA brackets. I know you've talked about those before as well, Mark. You're a big fan of those.
Not a big fan, just a big fan of avoiding them, but doing what you can, right?
Right. And so I think, for some of the higher earning pilots, they're still going to be hitting some of those metrics anyways. Yeah. But doing a little extra conversion, if you're happen to be in that phase of your life, not a big deal.
Well, and to that point, right? So if make sure you're talking with your CPA about some tax loss harvesting. Obviously, since the election, the market went on a bit of a peak. Had a couple of good, had some runs, cooled a little bit, So if you've got some capital gains issues you're worried about, right, Scott? Then you also could look at also getting rid of some dogs and doing some tax loss harvesting.
Yep, tax loss harvesting was the next one on the list, and so absolutely we need to have that done before December 31st. And as a refresher for folks on that one, because you hear that phrase tax loss harvesting, what does that mean? Yeah. Well, basically what we're looking at there is, in that taxable bucket, we have taxable, tax deferred, tax free that we always talk about. In that taxable bucket, our capital gains are taxed and our ordinary dividends are taxed. You have until the end of the year to offset some of the gains with some losses.
Right.
And what we'll typically recommend there is you just own one style of holding and then buy a different one. And so like, let's say as an example, I own a real estate index fund and I own a technology index fund. I can sell a little bit of real estate at a loss and a little bit of technology at a gain. And then I could maybe put it all in the S&P 500 for 30 days and just let it sit there so it still stays invested.
Yep.
But I've harvested some of those gains and realized some of those losses, and they offset.
Yeah.
And so that way it resets my cost basis and enables me to be a little bit more tax efficient inside of that account.
And if you've got a dog, Scott, that you are trying to do that with, but you really like it, or you really want to keep that thing, you can do it. You can buy it back, right? You just have to wait for the 30 days because of the wash sale rule, right? So you have to at least, after the 31 days or whatever, 32 days, you can go back. If you're something you really dig, right? If it's a, company stock or whatever that you're just all about, that's fine too. So you're still being tax efficient.
Absolutely. And that's where, again, I don't recommend you sell something and then just sit in cash, because in that 30 days, you could definitely miss plenty of market performance to offset any of your tax efficiency. So again,
Right.
you don't want to get this confused with getting in and out of the market and getting into market timing.
Yeah,
but
great point.
It's more so just by facilitating. We want to keep the portfolio allocated the same way, but we have to facilitate some transactions in there to realize the gains and losses and get them to offset. So
yeah,
that's another good one that makes a lot of sense for a lot of people. So
okay, so what else we got on some end of year items, or even in the beginning of the new year as well?
I think those are two of the biggest ones that you want to work on by the end of the year. The other one would be I know we talked last time about some of the self-employed employment items from that the BOI business
From
ownership.
the boy.
Yeah, the business ownership interest getting
Sorry, I had to make that joke.
getting filed.
I've been waiting for 2 weeks to make that joke. I just really wanted to go like, what is this? The yeah boy.
The boy, yeah, I know, no kidding. So, but if you look at what they have here, but from the employer side, the employer also has to finish their contributions by the end of the year. So if you happen to be owning some sort of pretty sizable business that you have employees that you're making employer contributions to their retirement plans, those need to be done. Employee contributions, we can do those by the end of or by the tax deadline, April 15th. The employer contributions, those need to be done. So you might be, maybe your CPA has you doing a solo 401k to put more into a 401k for your business or your wife's business. You have to have those employer contributions done before the end of the year. So that'd be another one. Those are probably the biggest three. And that last one's really not super common amongst our airline pilot population, but for a lot of their spouses, or if they got a side thing going on, that could be it. So now looking out to 2025, I always like to talk this. We'll get a little bit into the numbers here on a couple things. Okay.
Just saying it. Let's take just a quick second. Just saying 2025 is just weird.
Dude, it's here, man.
Yeah.
2025. Dude, I joined the military in 2005, and I thought, when I retire one day, it's going to be 2025. I probably won't even do that. Well, here I am getting ready to hang it up in January, man. It's coming quick.
It's crazy.
I know. My oldest is graduating high school in 2025. It's nuts. Can't believe it's here. So
I don't even want to tell you about mine. So
we won't ask.
Yeah.
So, but let's talk numbers here for a little bit. Okay. So the IRA contributions not changing. Was 7,000, is 7,000. The catch-up contribution, same. Was an additional 1,000, stays an additional 1,000. The Roth IRA income limits are going up slightly. They were 230,000 for a married couple, 146 single, going up to 150 single, 236 married. So most of our folks are still going to be above that. And again, this is one of the biggest mistakes I see almost every call I'm on. The guys are like, I make too much money to get into the Roth IRA. Most of the time, we can work that backdoor Roth IRA process with them. If you want to learn more about that, we more than happy to have a conversation with you and spend some time educating you on it. The backdoor Roth.
It's legal. It sounds funky, but it's totally legal. Yeah.
Absolutely legal, absolutely ethical, absolutely moral. And dude, I mean, almost every guy I've ever met is not doing it when they could be doing it. So that's something that we should absolutely be doing. But again, if you're under 50, you could be doing 7,000 into the Roth IRA through that back door, or 8,000 if you're over 50. 401k contribution for the employee is going from 23,000 to 23,500. So that's hardly changing at all. I was kind of surprised that didn't change more. But so you'll want to make a slight adjustment on that. Most of our guys are maxing them out in the beginning of the year, within the first few months. The HSA contributions going up a couple $100, $8,300 to $8,550 for the family. Social Security
hopefully people are taking advantage of the HSA. It's a fantastic tool.
One thing I'll say on the HSA, most of the time we run into the guys have it just sitting in cash because it's a smaller account. Mm-hmm. And so I do understand that it's not, I understand that it's not like a huge portion of somebody's wealth. Right. But again, max that sucker out. You're going to use that for health care related expenses in retirement. And
it's like a Roth on steroids. It's like triple tax efficient. So
yeah, I mean, you're getting the tax deduction going in, you get it out tax free. You're going to use it for health care.
And it grows tax free.
Yeah. So $8,550 going in. Keep that thing invested aggressively. You're going to need it eventually. So, but get it growing. Don't just let it sit there in cash.
Yeah, exactly.
Standard deductions going up a little bit, from $29,200 to $30,000. So nice even numbers at $15,000 for single, $30 for couples. The gift limit's going up from $18,000 to $19,000. And then the last one on here, mileage deduction, they haven't released that one yet, but
And I guess, Scott, this will probably stay, but then again, we don't know what will happen either. Obviously this is December. So once, Trump comes in January, we'll see what kind of changes come down the pike. I doubt they'll make anything retroactive, but they could. Yeah. So it's totally possible that they could do that, especially if they make the TCJA, if they extend it, like talked about that a couple of weeks ago on the show, or if they make it permanent or whatever. So there still could be some more changes, but this stuff is all important end of the year stuff. And it's why it's important to talk with your advisor, right? Talk with your people, get your team on, and make sure that you're, getting set.
Well, and I think, those numbers are good to think through in terms of like, hey, making sure you're setting up cash flow to get all that stuff taken care of. Getting the $8,000 a year per spouse. You just start to stack all these things up. And then all of a sudden, when I was putting nothing over into tax-free, now all of a sudden between the HSA and the backdoor for me and my spouse, I'm getting $24,000 a year over there with some compound interest. You do that for 4 or 5 years. And all of a sudden you're like, dang, man, we got a pretty good chunk over there I didn't even really miss it. Yeah.
Well, what if it's a decade? What if you start this at 52 or anything over 50? Because especially with the, the catch-up contributions after 50, and you go that, to 62 early retirement or 64 or 65. I mean, it's not chump change.
I mean, you're going to be pushing it. Let's say you're 45 and, you get that $24,000 a year going over into that tax-free bucket.
For 20 years.
Dude, I'm going to run it for you right now. So 20... We normally don't do this live on the show, but here we are. So that 24,000 in there a year at 8% for 20 years, you're looking at 1.2 million. I mean,
so for people who feel like, oh, I'm started too late, maybe not.
Well, and especially most of our guys that are senior first officers or junior captains, they're going to be low 40s if they're just kind of hitting those higher earnings, and then it just goes up from there. Mm-hmm. I mean, it's not too late to just be like, I got all my stuff going in the 401k. I'll have a couple million in there by the time I retire. It's good, man. With just this much little adjustment, a couple account setups, a couple transaction things that we do every year. And just get that on autopilot. I mean, it's not autopilot for us. We got to do the work for the client, but you get that on autopilot for them where they're just not they're not missing that $24,000 a year.
Yeah.
I mean, it makes a huge difference. So
pay your future self, man, and pay it
absolutely. So, and again, to your point, let's say you just wanted to do it for 5 years, you're still going to have $175,000 to $200,000 over there.
It's not chump change.
That ain't chump change. So now, last thing I'll talk about here would be like the federal tax brackets. If we look at the adjustments to those, obviously the brackets themselves, the percentages aren't changing, but the numbers are changing a little bit of what defines the bracket. So most of our folks are in that 24 to 32% bracket. So the 24% is 206,000 to 394. 32% is 394 to 501.
Is that single or married?
That's married.
Yeah.
That's married. So most of our folks will be in that 24% bracket. Some will be creeping up into the 32 if they're, got a joint income or one of the higher earning folks. But man, I tell you, in that 24 to 32% bracket, you got to be looking at the tax plan. What can we do this year to maximize deductions? If you're just a W-2 employee and that's it, you're taking the standard deduction. It is what it is. But you got anything else going on that we can take deductions on? And then setting that aside, the biggest thing you can do for your tax self, your future self from a tax standpoint, it's not trying to maximize deductions. That, okay, maybe I save $1,000 this year if I uncover some nugget. Cool.
Right.
But how do I make sure that I'm saving, investing, and managing all that in the most tax efficient way for the future? Because again, through maybe adjusting where my contributions are going, adjusting this backdoor Roth thing we talked about, making sure the HSA is getting maxed out, making sure it's invested correctly. I do all these couple little things, and these guys don't even really miss the cash throughout the year, but that sets you on a very, very different trajectory where you land in retirement and you're saying, whew, I'm glad I did that 20 years.
Yeah, for sure. Yeah. Oh, absolutely. Right. I mean, that's why you're that's why this is the Wealthy Pilots podcast. You're the pilot's planner, right? A couple little tweaks, couple little knob turns, and you're sitting pretty a little bit later on.
And dude, I'm telling you, dude, these guys, this is like, if you're flying most of our folks are Southwest, Delta, United, American. Some of the other carriers too, Alaska, Hawaiian, JetBlue, et cetera. But those four are the bulk. If you're in those major, let's call it top 10 airlines, you're probably in the top 5, maybe even top 2% earning pilots in the world. Some little micro adjustments with what you're doing, with how you're saving, got to make a big difference over time. And it's not even going to take like decades. I'm saying even over a few years, you really start to see pretty quickly how a little adjustment in the 401k to make that perform a little better when it's getting 17 to 18 to 19% contributions from the employer plus the employee. A little tweak on where we're saving from a Roth standpoint or traditional, and what we're doing on the outside of the IRA and 401k investments and making those a little more tax efficient. Just a few years in, the numbers start to really compound on themselves, and it makes a very noticeable difference. So, if you're in a top 5% earning, part of your profession, be seeking that top 5% of advice to make sure you're getting the best results you can.
There you go. And if you need help with that, check the show notes for the descriptions. We talked about the backdoor Roth earlier. So if you've got some questions around some of this stuff, reach out to Scott, get onto his calendar. Don't let the end of the year be the reason that you don't, because you're busy with other stuff. I get it. But schedule some time on the calendar. Get yourself some time to chat with Scott. You can find all the information again in the show note description details. Of course, you can go to retireairlines.com. That's retireairlines.com. And don't forget to subscribe to the podcast on Apple, Spotify, and YouTube. And Scott, thanks for hanging out and breaking it down, brother. Always appreciate it.
Happy holidays, man. We'll see you soon.
We'll see you soon here on another episode of the Wealthy Pilots Podcast with Scott Osborn.
Is your 401k working as hard as you are? Let's find out at thepilotspanner.com to get started with your free full thrust 401k toolkit. Come see what a good financial co-pilot can do to help make sure your retirement is ready to take flight. Visit us at thepilotspanner.com. That's thepilotspanner.com.
Information is for illustrative purposes only and does not constitute tax, investment, or legal advice. Always consult with a qualified investment, legal, or tax professional before taking any action.